Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamwin, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their home ownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode.
Today, we're delving into the surprising rise in Toronto real estate prices, even as sales have significantly dropped. According to the Toronto Regional Real Estate Board, home prices in Greater Toronto climbed in February, despite sales collapsing by 25% to one of the lowest levels on record.
It's quite fascinating, Steve. One might expect that with such a significant drop in sales, prices would decrease. But instead, we're seeing prices rise. What's driving this trend?
It seems to be driven by what some experts are calling credit-driven exuberance. The Bank of Canada recently warned against mortgage tinkering, suggesting that it could lead to this kind of scenario where prices rise despite weak demand. Essentially, buyers are willing to pay more, even as inventory levels reach their highest since the global financial crisis.
That's quite a term, credit-driven exuberance. It seems to suggest that buyers might be overly optimistic or confident about their financial situations, perhaps due to accessible credit options. But from a heartful perspective, it's essential to consider the potential risks for these buyers as well.
Absolutely, Janine. While the current price rise might seem like a positive sign, it's crucial to remember that the annual trend is actually moving in the opposite direction of a recovery. The benchmark price of a typical home increased by only 0.4% in February, which is significantly smaller than the increases we've seen in previous years.
And with the sales to new listings ratio dropping to 34%, it indicates that the market is oversupplied relative to demand. Typically, a ratio below 40% suggests that prices might eventually fall. It's a complex scenario, and I hope that those looking to buy or sell are considering all these factors carefully before making decisions.
Indeed, Janine. It's a reminder of how important it is to stay informed and to consider both the numbers and the broader context. We'll continue to monitor these developments closely and keep our listeners updated on any changes. Let's shift our focus to the recent changes in policy by the Canada Mortgage and Housing Corporation, or CMHC. The agency's decision to block the bundling of single-family homes under the Mortgage Loan Insurance Select program has left many builders and investors in a state of uncertainty.
That's right, Steve. This sudden shift has caught a lot of people off guard. Builders and investors who were relying on this program to finance their projects are now scrambling to find alternatives. It's concerning to think about how many planned housing projects might be in jeopardy because of this.
Critics have indeed raised concerns that millions of dollars in housing projects could be affected. The CMHC announced that it would no longer approve applications unless there are at least 5 rental units in the same building and on the same lot. Previously, investors could bundle adjacent properties, which was a popular option.
For investors like Tawfiq Abdul Samad from Edmonton, this change has been particularly challenging. He had plans to finance 3 detached homes with basement apartments, totaling 6 rental units, but his application was rejected. It's a tough situation, especially for those who had already made financial commitments.
And it's not just about individual investors. Jake Steinman, the CEO of Meta Realty, mentioned that his firm has several deals now in jeopardy, with significant sums already invested in deposits. This has created a ripple effect, potentially impacting a wide array of developments.
From a heartful perspective, it's important to think about the broader implications for the housing market. Industry groups are warning that these restrictions could slow down rental housing development. The CEO of the Build Alberta Association, Scott Fash, has criticized the handling of this shift, advocating for existing applications to be grandfathered in.
On the other hand, CMHC has defended its decision as a clarification rather than a policy change. They argue that the move aims to provide a clearer understanding of their expectations and to prevent large commercial investors from dominating the market. It's a complex issue, and there are certainly different perspectives to consider.
Absolutely, Steve. While CMHC might be looking to curb the influence of large investors, it's crucial to balance that with the needs of those who are working to increase the availability of rental housing. It's a delicate balance and one that requires careful consideration of all stakeholders involved.
In our final segment today, we're turning our attention to Rocket Mortgage Canada's recent decision to wind down its operations by the end of June. This move comes as its parent company, Rocket Companies, shifts its focus back to growth in the American housing market.
That's quite a significant development, Steve. Rocket Mortgage Canada has been a part of the Canadian mortgage landscape since 2020, initially launching as Edison Financial. It's a bit of a surprise to see them stepping away, especially after gaining traction so quickly.
Indeed, Janine. In just a few years, they reached $1 billion in annualized submitted volume and expanded from Ontario to nationwide. Their digital-first approach and access to Rocket's proprietary technology differentiated them from traditional lenders. However, it seems the Canadian market's unique challenges, like entrenched broker-lender relationships and rising interest rates, proved difficult to navigate.
From a heartful perspective, it's also important to acknowledge the impact on Rocket Mortgage Canada's employees. The company has assured that while most staff will be laid off, some will find roles at Rocket's other Canadian businesses, like Lendesk and Rocket Innovation Studio. They're also providing severance packages and career transition services, which is a responsible approach.
Yes, and it's worth noting that Rocket Mortgage Canada assured clients that all loans currently in progress will be completed as planned. This ensures that their existing commitments to clients are honored, maintaining trust even as they exit the market.
It's a reminder of the complexities of the mortgage industry and how external factors like regulatory changes and interest rates can influence business decisions. Rocket Mortgage Canada had an ambitious vision for transforming mortgage lending, but sometimes the market conditions simply aren't conducive to such bold plans.
Absolutely, Janine. While the Canadian market presented challenges that Rocket Mortgage Canada couldn't overcome, their efforts to innovate and compete with established players were noteworthy. It underscores the importance of adaptability and understanding the specific dynamics of each market.
As we wrap up, it's essential for those in the industry to learn from this experience. Whether it's understanding the nuances of the Canadian market or supporting employees through transitions, there are valuable lessons to be taken away.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time and stay informed with the latest industry insights.